Understanding your paycheck is more than just seeing the money hit your bank account. A pay stub shows how your earnings are calculated, what deductions are taken out, and where your tax dollars are going. In this session, we'll break down the anatomy of a pay stub, explain common terms and deductions, and highlight what to look for to ensure that your paycheck is correct. Each pay stub provides a detailed breakdown of your earnings, taxes, and deductions, helping you understand exactly how your take-home pay is calculated. Reviewing your pay stub regularly is important because it allows you to verify that you're being paid correctly, confirm that your withholdings are accurate, track benefit contributions such as retirement and health insurance premiums, and to maintain proof of income for things like loan applications or rental agreements. Pay stubs can give you transparency into your pay and protection against errors. The key sections of a pay stub disclose employee and employer information, earnings or gross pay, taxes that were withheld, other deductions like health insurance premiums, employer contributions, and net pay or your take-home pay. Some common payroll codes you might see on your paycheck are YTD, this could be hours worked or pay received since January 1st, FICA, which refers to taxes paid, EE is money taken from the employee's paycheck and applied to a benefit like retirement accounts or health insurance. ER is money the employer paid on behalf of the employee. Pre means the deduction was taken before taxes were applied to the paycheck. And post is referring to a deduction that was made after taxes were taken into consideration. Knowing how federal, state, and payroll taxes work helps ensure the right amount is withheld from your paycheck. This helps you avoid owing money at tax time or overpaying and giving the government an interest-free loan. Understanding taxes also clarifies the value of pre-tax benefits like 401ks and health savings accounts. It enables you to make choices that maximize your take-home pay and your long-term savings. Let's take a deeper dive into the tax portion of your pay stub. Income tax withholding is the process by which your employer deducts federal and sometimes state or local income taxes from your paycheck. This ensures that you pay your taxes gradually throughout the year rather than owing a large sum at tax time. At the end of the year, the IRS and state tax authorities reconcile your total tax liability with what was held and paid by your employer throughout the year. If too much was withheld, you will receive a refund. If too little was withheld, you will owe the difference. Federal income taxes are the largest source of revenue for the U.S. government, and they're used to fund a wide range of programs and services. Roughly 2/3 of federal spending is on mandatory programs like Social Security, Medicare, and Medicaid. The rest is discretionary spending that can be used for things like defense, education, or infrastructure. FICA is short for the Federal Insurance Contributions Act. FICA is a payroll tax that funds Social Security and Medicare programs, and it is collected from both employees and employers. The Social Security FICA tax pays for retirement, disability, and survivor income benefits. It is applied only up to a yearly wage cap called the Social Security wage base. Wages above this cap are not subject to Social Security tax. Unlike Social Security FICA taxes, all wages are subject to Medicare FICA taxes, and high wage earners may be subject to an additional Medicare tax. Medicare taxes go to medical coverage for seniors age 65 or older and disabled individuals. State withholding tax works a lot like federal income tax withholding. Your employer withholds part of each of your paycheck and sends it to the state revenue department. That money goes towards funding the state's general budget and public services. It is used to fund public education, healthcare, safety, transportation, and infrastructure services. It also covers the operational costs of state governments, including salaries of state employees. FUTA stands for Federal Unemployment Tax Act. It's a payroll tax paid by employers only, not employees. This money funds the federal government's role in the unemployment insurance system. The unemployment insurance system provides loans to states when their unemployment funds run low, extended unemployment benefits during high unemployment periods, and job service programs to connect people with work. Regularly reviewing your pay stub ensures accuracy, compliance, and financial awareness. It's important you verify hours worked in your pay rate, check deductions for accuracy, track year-to-date totals for taxes and retirement contributions, report any discrepancies you identify immediately, and ensure tax withholding matches your Form W-4. The W-4 form is an IRS form used by employees to tell their employer how much federal income tax to withhold from their paychecks. It ensures the correct amount of taxes withheld so you don't owe too much or receive a large refund at tax time. It's important to complete an updated W-4 whenever your financial situation changes. For example, if you get married or divorced, have a birth or adoption of a child, or have any significant changes in your income. There are 4 steps outlined on the Form W-4. Step 1 on the W-4 is where you provide your personal information. Here's where you enter your name, address, social security number, and you select your filing status. Your filing status determines your standard withholding rate. Step 2 of the W-4 is where you disclose information about you and, if applicable, your spouse that could affect the amount of taxes your employer withholds from your paycheck. You would complete this section if you have more than one job or a working spouse. Step 3 is where you disclose information about your dependents. Dependents will reduce your amount of withholding. Step 4 is where you disclose any other piece of information that can affect how much taxes you should have withheld from your paycheck. Examples would include sources of income other than work, like investment interest, dividends, or distributions from retirement accounts, deductions other than the standard deduction if you itemize on your tax returns, or extra withholding if you would like to have extra tax withheld from your paycheck for any reason. A W-4 that's not completed correctly can cause unexpected issues at tax time. This is why it's crucial to accurately complete your W-4 and update it whenever your financial situation changes. Under withholding of taxes can result in a large tax bill and potential penalties when filing your federal or state income tax return. Over withholding of taxes can reduce your take-home pay unnecessarily. You may get a refund at tax time, but you effectively gave the government an interest-free loan all year. Choosing the wrong filing status can miscalculate withholdings and may affect eligibility for other tax credits and deductions. To ensure your W-4 is completed accurately, it is recommended you ask your CPA to weigh in, update your W-4 whenever life changes, use the IRS tax withholding estimator, and review your pay stub regularly to ensure correct withholding. It's important to know how your gross pay becomes net pay. By understanding the deductions on your pay stub, you can ensure accuracy, track your benefits, and make informed financial decisions. Make sure to take time to review it, ask questions when something doesn't look right, and use the information to plan confidently for your financial future.